Thank you very much for joining once again. My name is Michele Ferrario. I'm the co-founder and CEO of StashAway. And tonight we're talking about private markets and specifically private equity, infrastructure, and private credit. We have the luck of having Hamza Azeem as our guest tonight and our main speaker. He's a managing director with Hamilton Lane. Hamza, again, thank you so much for your time. And because tonight the webinar is for accredited investors only, we will be able to go in a bit more detail than we can do publicly on the specific funds that are currently available on the StashAway platform. Now, we will carve out some time at the end for Q&A. So please do use the Q&A function that is available on Zoom to ask your questions. And otherwise, I'll start with a bit of an introduction, and then I'll let Hamza go in a bit deeper into each of the propositions we currently have available on the StashAway platform. First of all, let me make 10 steps back and look a little bit holistically at what you can find on the StashAway platform and how the topic of tonight, so the semi-liquid private markets product, fit into all of this. So as you know, the core product that StashAway has been became famous for is our core portfolios. This is the products that help clients build diversified exposure towards all public asset classes. So public equities, public fixed income, so bonds, both government and corporate, gold, real estate, etc. And these are what we call general investing. We have a few solutions there, managed portfolio, managed by our own asset allocation framework called ERA. We have general investing managed by BlackRock, as well as flexible portfolios where you can build your own asset allocation. We have a fairly developed cash management suite in both US dollars and Singapore dollars. You're not going to get rates as good as you can get from these products anywhere else because our fees are very low on these products. And we also offer the ability to diversify further your exposure through thematics. This is again in the public equity domain. So using ETFs to get exposure to publicly traded companies. And then we have alternatives. And if you've been with StashAway for a bit of time, you might know that 2.5 years ago, we launched a kind of a classic private equity venture capital program that's done the classic way. So getting exposure to close-end illiquid funds. And it's a program I'm very proud of. I think it actually enables people to have real exposure to private equity. We also have angel investing in crypto. But tonight, we are looking at our semi-liquid offering. So private equity, private infrastructure, and private credit. These are products we made available more recently, have been very successful because they provide a fantastic way to access private markets for our clients. So this is the focus of tonight: private equity, private infrastructure, private equity, the semi-liquid suite. Now, why would you want to allocate to private markets? And Hamza will go in a bit more detail in a second, kind of a vertical by vertical. But at a high level, one reason obviously is returns. So broadly speaking, private markets can give you access to higher returns than public markets can. Second is they do it actually with overall lower volatility, so reducing a little bit the risk. And third, and very importantly, they provide diversification. Oftentimes, private market can be uncorrelated to public markets, and so within your portfolio can actually smooth your ups and downs through kind of that normally public markets will have. And so having some private markets exposure improves your overall risk-adjusted returns, both by improving returns as well as decreasing overall volatility of your portfolio. Institutional investors, so the Temasek, the GIC, the Harvard endowments of this world, allocate on average 23% of their total portfolios to alternative investments. In my experience, kind of a high net worth individuals that have less than $10 million tend to be in many cases, they are still at 0% allocation. In some cases, people have started to get this allocation. 5, 7, 8 years ago, it was actually difficult to build a proper allocation. We make it very easy, giving access to kind of the best allocation you can possibly get. So hopefully you'll find a way to fit private markets within your portfolios. As I mentioned, there are three products we offer in the semi-liquid private markets. Private credit, so this is giving access to credit. Again, Hamza will go in much more detail. The target return is 8 to 10% per annum. Last year, it did 10.3%. It's a so-called all-weather strategy, very diversified, very targeting the least risky of part of the cap table of companies. And again, Hamza will go in more detail. We recently launched an offering on private infrastructure, targets 10 to 12% per annum. It's a very unique opportunity to get access to what's happening on the infrastructure side, with a lot of government actually looking for private capital to build or own private infrastructure. So there is a lot of opportunity there for good returns. Again, Hamza will go in much more detail than I'm doing right now. And on the private equity front, again, this is a way to get broadly diversified private equity and venture capital exposure, targeting 10 to 12% per annum. The target cash return is lower than you would do if you invest in any liquid fund, but the reality is that from a cash on cash efficiency, because of the fact that there is all the money is called immediately and deployed immediately, actually it's an efficient way to get exposure to the asset class without the illiquidity of the classic program. Personally, I have both the illiquid, the semi-liquid, as well as the classic program in my personal portfolio, and I'm happy to go into the details of why later. So as usual, we try to make it simple and cost-effective to invest intelligently. So the simplicity part is that these are semi-liquid. There are monthly subscription and redemption. So in practice, you can invest any month. You can start with as low as $20,000. You can then top up in $5,000 increments. What we saw last year for private credits, people starting with $20,000 and then 3 months later put $500,000. We will, and this is obviously because people got familiar with our offering and doubled down on that. The fact that it's semi-liquid again means that while these are long-term investments that you should think of as long-term, if for whatever reason you need or want to pull out money, it is something you can do on a monthly basis. Again, obviously, it's not as liquid as investing in our core portfolios or in our cash management products, but is significantly more liquid than in our private equity venture capital classic program. If you want more information specifically, obviously, first of all, ask questions tonight. Listen to Hamza go into more detail. But secondly, feel free to reach out to any of my colleagues. I put in here Janelle, Vincent, and Kimi phone numbers for Singapore and Pacey for Hong Kong, as well as a QR code that will help you find a wealth advisor to speak to. If for whatever reason you lose all of this, just write to us at support@stashaway.com, and we'll make sure that you talk to the right person. All right. I hope I did a decent job at introducing the topic, but most importantly, I did it quickly enough so that we leave as much time to Hamza as possible to go a bit deeper. Hamza, I'll let you share your own screen so that you can then control the presentation, and I'm looking forward to listening to your presentation and then ask you a few questions at the end.
Thanks a lot again. Thank you, Michele, for the introduction, and thank you everyone for being here. Appreciate it. It's late in the evening for most of you. So as Michele mentioned, 3 key products we are talking about, all evergreen, semi-liquid, open-ended. These are terms that you will hear interchangeably across 3 different asset classes: private equity, credit, and infrastructure. But before I do that, a quick introduction to Hamilton Lane as a firm. So we've been around for over 30 years. Private markets is all we do and have ever done. So we don't do anything in public markets. Over 900 billion in assets under management and supervision, and we deploy anywhere between 30 to 40 billion dollars in private markets on an annual basis, which makes us one of the largest deployers of private capital globally. Global presence: we are present in over 20 countries with over 700 employees across these offices. A quick snapshot of the Evergreen platform, and again, we'll only be talking about 3 of the products from the platform. But we launched a platform back in May of 2019 with our first product, the Global Private Assets Fund, which we'll be talking about today. Over a period of time, as the market has grown and evolved, we've added new products to this evergreen platform. The philosophy behind it being, and again, we'll dig deeper into some of the nuances that typically come associated with private markets as an asset class. The idea was essentially for private wealth investors, for investors who want to access private markets as an asset class in this open-ended semi-liquid fashion, to be able to pick and choose across different strategies, similar to the traditional closed-end private market funds, but in this open-ended framework. So we started off with our multi-strategy or equity-oriented strategy, followed by credit, followed by infrastructure, and we continue to expand it. So where we are today, over 6 years of experience in these evergreen platform, which by the way, it seems short, but given the nature of these evergreen open-ended products, is one of the longest in the industry, and over 11 billion, now close to 12 billion in AUM just on these evergreen products. So starting with the first product we're talking about today, which is the Global Private Assets Fund, or GPA as we call it, and this is our private equity-oriented strategy. So first and foremost, why private equity and what is private equity? And again, most of you would be familiar with it, but as a quick recap, it refers to investments that are not publicly, not traded on a public exchange, and essentially you can get access to them through these private equity funds. These are privately held assets. Why would you want to get access to them? And Michele highlighted some of the stats earlier on about how much institutional capital is dedicated to alternatives and within that private markets and private equity. The reason for that is from a return standpoint, from a volatility standpoint, it does provide investors with a superior experience. So if you look at the growth of $1 since, say, 2000, what an investor would have experienced in public equities relative to private equities, there is quite a stark difference. But let's contextualize it a little bit further to actually sort of put in context the size of private markets relative to public markets. And here, you're looking at a chart that is showing you the percentage of companies with revenues over $100 million in each of these geographies, North America, Europe, and Asia. What percentage of those companies are publicly held, which is the dark blue section of the bar, and what percentage of companies are privately held, which is the light blue section of the bar. Again, slightly varying numbers across the geographies, but the key message is that a vast majority of companies, and these are not tiny companies, these are companies' revenues north of $100 million, are actually privately held. So if as investors you want to get exposure to a specific geography, to an overall economy of a particular region, you do need some exposure in private markets because it is a significantly larger market relative to public markets, given most companies are privately held. So what is the Global Private Assets Fund? And here we say from an asset perspective, it has private equity, a little bit of credit, and I'll get to that in a bit more detail as well. It has a target return of 10 to 12% on an annualized basis, and this is net of all fees and expenses. The idea behind it is for investors to experience a return profile that is superior to what they would experience in public markets over the longer term, and to do so with significantly lower volatility compared to what they may experience in a public markets portfolio. As I mentioned earlier, this was the first fund we launched from our Evergreen platform, so back in May of 2019, and today in terms of size is over $6 billion. The nature of this fund is such that you come into a portfolio fully deployed. So whatever you as investors are committing, whether that is $100K or $2 million or whatever the amount might be, in its entirety, the entire amount is called on day one. So you're coming into a fully deployed portfolio right from the onset. It also has the benefit of a dynamic asset allocation policy. And again, we'll get to in a minute in a bit more detail how we put it in practice in a day-to-day basis as portfolio managers for this fund. And then last but not the least is the investor base. The investor base is fairly diversified for this fund, both by geography as well as the type of investors. So today, you have investors from all across Europe, the UK, Canada, Australia, the Middle East, and Asia. If you look at the nature of investors, you see single-family offices, multi-family offices, high net worths, also some institutional investors like endowments and pension plans. So a fairly diversified investor pool using it as a tool within their broader portfolio management or construction. So if you think about how this fund compares to a traditional private equity fund, and again, these differences will be consistent and will apply not just for GPA, but also the credit strategy and the infrastructure strategy that we will talk about. Firstly, is capital deployment. In a traditional private markets fund, you come in, there's a multi-year commitment period. The manager goes through a fundraising period, they go and get commitments from investors. Once the fundraising is done and the investment period commences, capital calls are made, meaning capital is called from investors to make the investments on a regular basis. So as an investor, you've made a commitment, you're waiting for your capital to be called, and your capital will be called in chunks and pieces as your manager is making investments. Eventually, as the fund starts exiting the investments, you as investors start getting your money back, your distributions back. So it's a multi-year commitment period. In comparison to that, in these evergreen funds, you're coming into a fully deployed portfolio. Whatever is committed is all called upfront on day one. We don't have to worry about when the capital will be called, what to do with the cash while you're waiting for the capital to be called. So from an administrative standpoint, it is significantly easier, a lot more straightforward. Also, the minimum amount that is required to invest in a traditional private equity fund is typically north of $5 million. In comparison with these funds, it's significantly lower, and Michele went through some of those earlier on. Next one is liquidity. In a traditional private equity fund, once you've committed the capital, your capital is typically locked in for a period of 10 to 12-year period, because you essentially have to wait for investments to exit, for the manager to sell the companies, for them to get the distributions, and therefore in turn to make those distributions to their end investors. In comparison, for these evergreen funds, there's some level of liquidity available. I would reiterate, it still is a long-term asset class. You should still think of it as an illiquid asset class, but there is some level of liquidity available. The liquidity is typically capped at 5% of the NAV of the fund on a quarterly basis. So it's not capped at an individual investor level. Any one investor can redeem in full at any given point in time, but it is capped at the overall fund level because at the end of the day, the underlying asset class is illiquid. In our funds, we offer liquidity on a monthly basis. Typically, for most products in the market, you see liquidity for these semi-liquid funds on a quarterly basis, but we have it on a monthly basis for all three of the strategies we're talking about today. Next one is diversification. Again, in a traditional private equity fund, you typically, if you wanted to get access to a large number of managers, you would go through a fund-of-fund approach. And what that does is it adds 2 layers of fees to your overall return. In comparison, for our evergreen funds, we have a multi-manager approach where we as Hamilton Lane co-invest alongside other managers directly into the asset. So these are not commitments to their funds. We are diligencing every individual investment that we go in and co-investing alongside them. So you as invested in these funds through a single allocation are getting access to a large number of managers across the board. So the portfolio ends up being not just diversified by industry, by sector, by geography, but also by general partners or the private equity or credit firms that you're getting exposure to. And again, we'll see some of the numbers for the funds in a bit more detail. And then last but not the least is what I'd mentioned on the previous slide as well, is the dynamic asset allocation. In a traditional private equity fund, you're more likely than not committing to a specific strategy, in some cases even specific geographies, specific sectors and industries. Given these funds, the evergreen funds or semi-liquid funds are constantly deploying capital, you have the ability to tilt between different parts of the market depending on where you may see attractive opportunities at any given point in time. And again, we'll see in a minute a couple of tilts I'll give you as examples of where we saw an opportunity which was market-driven and had the ability to tilt the portfolio into that part of the market to take advantage of it. So at a high level, it reduces the administrative burden. It lowers the minimums significantly. There's no multi-year commitment period. You go into a fully deployed portfolio. and there is some level of liquidity available in these funds relative to a traditional private equity fund. So if you look at GPA, what do we invest in? We spent a couple of years before we launched these products to think about different iterations of what the portfolio would look like to achieve the return profile, the risk profile, but also, most importantly, the liquidity profile that we want this fund to achieve. We looked at many different iterations. It could be a combination of publics and privates. It could be a liquid bucket in the portfolio. Where we landed was that we should set the portfolio such that we have liquidity being naturally generated from within the fund. So where we landed was three key buckets that we invest in this fund: direct equity, direct credit, and secondaries. And what each of these buckets is doing from a return perspective and a liquidity perspective is a little bit different. The direct equity bucket is where we are co-investing alongside another private equity player directly into the equity of the company. The direct credit bucket is exactly like the direct equity bucket, but instead of going into the equity of the company, we are co-investing alongside a private credit player directly into the debt or the credit of the company. And then the secondaries is where if there's an existing, some of you might already be familiar with the secondary market, but as a quick introduction, think of it as an existing private equity investor, say it's a pension fund, that has private markets exposure to a number of portfolios. They now want to get some liquidity back and can't necessarily wait to get the distributions from their managers. They can come to the secondary market to sell the portfolio, where there's buyers like us, like others, who are able to buy these portfolios in the secondary market. Now, because you're acting as the provider of early liquidity to the seller, you're typically able to buy these portfolios at some sort of a discount. So what each of these buckets is doing from a return and liquidity perspective, as I mentioned, is a bit different. If you think of the direct equity bucket, this is where you're going in alongside a private equity player right on day one, and the whole value creation point, it would sit at the top of the stack. However, from a liquidity standpoint, it would sit right at the bottom of the stack because the whole life cycle of the transaction may be anywhere between, say, 5 to 7 years. So highest return, lowest liquidity. Next, you look at the direct credit bucket, the opposite end of the spectrum. Lowest from a return standpoint because you're in the more secure part of the capital structure, but highest from a liquidity standpoint because these are underlying loans. They will be generating steady state income, and typically the duration on these loans is much lower than your private equity transaction. So highest liquidity, lowest return for direct credit. And secondaries is somewhere in the middle, both from a return standpoint as well as a liquidity standpoint. Because you're entering into these transactions at that late stage inflection point, say 3-4 years into the life of the portfolio, where there still is some upside remaining, but the duration or the hold of these assets is shorter than that of the direct equity bucket. So what you notice here is each of these buckets is playing a slightly different role within the broader portfolio construction with regards to return and the liquidity profile that we want the fund to achieve. Here's a quick snapshot of what the fund looks like today, and it will keep on changing on a monthly basis as we deploy capital into new deals. Firstly, by investment type, is fairly balanced between direct positions. So this is predominantly direct equity, a small sliver of direct credit, and then secondaries. We've broken down secondaries here as well because there are different types of secondaries. And again, if someone's more interested, we can go into more detail of what these different types of secondaries are, but just in the interest of time, maybe I won't do it now. But a good balance between secondary transactions and direct transactions. More recently, we actually de-emphasized credit in the fund. The reason we did that is we wanted credit from day one as a liquidity provider. Now that the fund is over 6 years in tenure, some of our equity and secondary positions are naturally generating that liquidity. So given this is a private equity-oriented strategy, we want the investment type to be predominantly private equity as well. So we've de-emphasized credit, and this is an example of how we've made a dynamic shift. Similarly, in the last couple of years, the secondary market saw some very attractive opportunities, and we made the deliberate shift to slightly increase our exposure to the secondary market. And again, if we look at the return profile of the fund and what has driven the return, some of those tips have been beneficial to the return profile of the fund. Next is geography. About 70% North America, 25% Western Europe, and then rest of the world. This is a true reflection of what the global footprint for private markets generally looks like, and we want to replicate that in this fund. More recently, we've made a slight more tilt towards Western Europe, so that number has gone up a few single-digit percentages, but overall, this is the geographical footprint of private markets that you see. Now, the chart in the top right-hand corner is an interesting one because this shows you the number of general partners or private equity managers that we've co-invested with in this fund. What this shows you is through a single allocation, you're getting exposure to deals with a large number of managers, which otherwise would not be possible. So again, fairly diversified, where our belief is no one general partner is an expert at every sector and every geography. So what we really try to do is try and get exposure to areas where they have expertise and co-invest with them. Strategy.
Can I double click on this? And so in practice, the top right chart here, the GP spread, because when one of the reasons, and you might have heard me saying this before, one of the reasons why we decided to launch this product with you guys, that I think this is really what makes Hamilton Lane unique. And you mentioned earlier that you deploy $30 to $40 billion a year in private markets. That allows you to build incredibly strong GP relationship because you give them money on a yearly basis. And so you tend to be the first call of anybody looking for a co-investor, which is why you have such an amazing deal flow and the ability to then have the diversification that the chart on the top right of this page shows, like, with the many different GPs. Now, and I always, to me, the logic is always provide diversification. We started, our public market journey for ETFs. So same logic. Obviously, there's no proper ETFs for private equity, so you can't do that. It is an area where you still have alpha, obviously, from active management, and that's what you guys do here. Can you maybe, explain? This is not a fund of fund. Yes. And so there is no double layering of fees, but at the same time, it's de facto a multi-manager approach in terms of final exposure that you get.
Exactly. So think of the business as two different segments of Hamilton Lane. There's one part of Hamilton Lane that, as Michele mentioned, is making commitments to other managers. So we act as an LP into those funds because we have a separately managed business, which is significantly large, and we are making commitments on behalf of our investors into these funds. And what that means is more often than not, we are one of the largest investors in their fund. What that gives us is relationships with those GPs and access to direct deal flow, as Michele mentioned. So in this fund, we are not making commitments to other funds. It's not a fund of fund structure. We are going directly into the investment. So we have our own direct equity team, credit team, secondary team that is diligencing on a deal by deal basis and deciding whether we want to go into this investment or not. And by virtue of the relationships that we have with these GPs through our other part of the business, we are able to go into these transactions typically on a no fee, no carry basis. So our return profile on the deals is exactly the same as the private equity firm that is leading the transaction with you. The next thing I'll touch on is strategy. So it is a buyout heavy strategy, which is 75% of the fund. So performing companies that we are investing in, venture growth around 15%, and then credit at 10%. Again, over the last couple of years, we had sort of reduced our exposure to venture growth because valuations in that part of the market were pretty full. More recently, we've slightly increased it given some of the industry tailwinds that we've seen in that part of the market. And then finally, fairly diversified both by vintage year as well as industry and sector. So we're sector agnostic, invest across different industries and sectors, but really focusing on areas which we think are non-cyclical in nature and where we are going for more discretionary businesses, looking for those market leaders or price setters within their sectors or industries. So again, fairly diversified portfolio from different metrics, and we'll keep updating this on a monthly basis as we inform our investors of what the fund looks like at any one point in time. Moving on to the performance of the fund. So as I had mentioned, two key targets we had. Net return of 10 to 12% on an annualized basis, and for the investors to experience significantly lower volatility relative to public markets. So firstly, if you look at the chart on the top of the slide here, light blue bars, public markets, dark blue bars, the Global Private Assets Fund. So optically, you're able to see that investors have experienced a much smoother return profile relative to public markets. And if you look at the annualized return since inception that we've achieved, again, this is net of all fees and expenses, that's at 13%. Again, on an individual year-by-year basis, it will vary. This is a long-term asset class, and we need to look at the return profile over the longer term. With regards to size, as I'd mentioned, over $6 billion today, over 200 positions in the fund today. And if you look at the number of underlying companies, given some of these positions are secondary portfolios we've bought, it's over 2,000 names that you get exposure to. You have a number here for the chart that we had in the last slide, over 170 general partners of private equity and credit firms that we've co-invested alongside with in this fund. So to wrap up, overall, we continue to focus on more sort of small mid-market businesses for this fund. That has been the emphasis for us since the beginning, but that is an area where we see a sweet spot from a risk-return perspective. Of course, the sort of current geopolitics, the situation on tariffs is something we continue to monitor. We don't see a large impact on any of our existing positions in the fund today, but obviously this space continues to evolve, and we continue to monitor it on a regular basis actively to make sure any diligence we're doing on new investments are taking into account the current market environment. So that is on GPA, and again, as Michele mentioned, we can come to questions at the end, but I'll move on to the next one, which is SCOPE, or Senior Credit Opportunities Fund. Now, as the name suggests, this is focused on senior credit opportunities, but what is private credit and what do we mean when we say senior credit? Again, if you look at a typical capital structure for a leveraged buyout transaction, again, percentages can vary, but say 50% equity, 50% debt. Here for this fund in private credit, we are investing in the debt of the capital structure and within the debt, right at the top of the stack. So investing in senior credit. Essentially, these are not publicly traded loans. Typically, you have one or a few private credit managers that are providing the debt on a private basis. And within that, for this fund, we're focusing right at the top of the capital stack. But why private credit, and what are we seeing in that part of the market more recently? What we see is a significant amount of growth in private credit on a year-by-year basis. There's a number of reasons for it. One is the size of the market, and two is why it makes sense from a borrower perspective. From a borrower perspective, you see your private credit manager as a long-term partner. Typically, these transactions are much quicker to sort of conclude relative to if you're going to the public market and issuing a debt. There's certainty that the transaction will go ahead because it's less impacted by sentiment in the market. If you look at, they're familiar with the broadly syndicated loan market, it is very sentiment driven. It can disappear completely, liquidity can dry up, bank lending appetite can dry up, and then all of a sudden come back. Private credit has been steady consistently over the years. So from a borrower's perspective, it gives you the confidence, it gives you the confidentiality, and it gives you the ability to deal with more complex situations with one or a few managers that you're speaking to rather than trying to explain it to the entire market. But also, if you look at the size of the market relative to the private equity market, as we saw in the previous slide, if you typically imagine that 50% of an asset is funded by debt, 50% is equity, you would tend to think that private equity and private credit markets would be more or less at par with each other with regards to size. The reality is that is quite different. There's about a gap of $1.1 trillion in the size or dry powder of private equity relative to private credit. So there's huge room for growth, and that is what we continue to see year on year, where over the last few years, private credit as an asset class has continued to grow and therefore gain the investor attention as well. Even if you look at it from a return standpoint, it stands out quite nicely. So here you look at the return profile of public managers, which is or public markets or public market equivalents, which is the dark blue bars, and you look at, sorry, which is the light blue dot, and you look at the performance of private markets or private credit, which is the dark blue bar. And what you see over the last 21, 22 years is private credit has consistently outperformed its public market equivalent. So again, from a return standpoint as well, it makes sense for investors. So what is Scope or Senior Credit Opportunities Fund? As I mentioned, as the name suggests, we're targeting the senior most part of the capital structure here. Similar to GPA, it is an open-ended fund with limited liquidity available. Again, monthly subscriptions and monthly redemptions exactly the same as GPA, with redemptions capped at 5% of the NAV of the fund on a quarterly basis. Again, same as GPA. The target return for this fund are 8 to 10%, again, net of all fees and expenses, but there is some use of leverage at the fund level as opposed to GPA. So again, one slight difference relative to GPA. It also has a distribution target. Now with this fund, and the reason we launched it is a lot of our existing GPA investors wanted to have something which is focused on safety and yield and is yielding in nature, i.e. has an income component to it. So this fund, as opposed to GPA, does distribute on a quarterly basis to our external investors, where we set up a target of up to 8% when we launch the fund. Otherwise, pretty similar to GPA, where you have immediate deployment, no capital calls, administratively a lot easier, a lot lower minimum amounts to invest in. This was the third fund that we launched from our Evergreen platform, and this was launched in November of 2022, where we initially used some of our own balance sheet capital and then launched it for external investors. Fast forward to today, what does the fund look like today? Firstly, 100% of the fund is floating rate, so it has the benefit or has been benefiting from a higher interest rate environment that we are in. With regards to number of issuers, 100 plus issuers that we have in the fund, so fairly diversified portfolio. We've been going for also relatively conservative assets that we are investing in or loans that we're investing in. So to give you an idea of the size of the companies we're investing in, on average, the EBITDA of assets in the portfolio is about $190 million and relatively conservative leverage levels. So if you think about it in debt to EBITDA terms, around 5 times or 41% loan to value. Our target portfolio construction for this fund is at least 90% to be in senior credit and then 10% or less in anything else. Today, 99% of the fund is in senior credit and less than 1% is more opportunistic. From a geographical standpoint, it is again North America heavy because that is the largest and deepest market when it comes to private markets. Today stands at about 87%, a little bit higher than what our initial target was, but that is the part of the market where we're seeing most opportunity. We have about 13% in Europe as well. And then similar to GPA, fairly diversified both by credit sponsor as well as industry or sector that we are investing in. Naturally, this fund is a little bit younger relative to GPA, but as the fund continues to mature, we'll continue to see more and more diversification similar to GPA.
And as mentioned before, same logic from my perspective here on the credit sponsor side. This is the one piece of the chart that really makes the offering very unique. And the core reason, one of the core reasons why we decided to partner with you guys on offering this product is this incredible diversification that you get out of one fund. So yeah, the credit. So what we said earlier about exposure to a variety of GPs is also true on the credit side with exposure to a variety of credit sponsors.
Absolutely. So it's exactly the same logic as Michele mentioned, similar to GPA where we're co-investing alongside an equity manager. This is exactly the same, co-investing alongside a credit manager with no fee, no carry. So our return profile is exactly the same as, say, a CVC or whoever we may be co-investing alongside with. So again, if you look at where the fund stands today with regards to size, it's just under $1.5 billion in size. We've achieved an annualized since inception return of about 9.5%. And we've also been distributing higher than the max that we defined when we launched the fund. So our annualized distribution for the fund since we launched the fund is 8.75%. the distribution made on a quarterly basis. Now, one thing you will already also notice, which is not necessarily something that you see across some of the others in the industry, is there's not been a single month of negative performance for the fund since inception, because the return for the fund is really driven by the interest income that the underlying positions in the fund are generating. And we have a fairly conservative approach towards leverage at the fund level as well, meaning even if there are any fluctuations in the valuations of the assets on a month-by-month basis, overall, we've managed to achieve a positive month consistently since the inception of the fund. So again, the growth profile of this fund has looked very similar to GPA, which, as I mentioned, now is over 6 billion. This one obviously is newer, but still at 1.5 billion since its inception in November of 2022. To wrap up here, on this fund, the target is really safety and yield, consistency of return, and steady state income, 8 to 10% levered target return with up to 8% distribution, and we've been distributing ahead of that, similar to GPA, multi-manager with immediate deployment. Moving on to our third and final strategy, which is the Global Private Infrastructure Fund, or GPI. Again, as the name suggests, this fund is focused on infrastructure with exactly the same construct otherwise as GPA and scope. But firstly, why infrastructure? Again, you might have seen this already. Broadly speaking, you can classify infrastructure into economic and social infrastructure. Economic, where users typically pay directly for the services provided, and these are typically privately held. Social, these are government-provided services where you either indirectly through taxes or subsidized fees are paying for the services, typically more in the public space. But why private infrastructure as an asset class is an important part of your overall toolkit? A number of reasons. First and foremost is overall, it enhances your risk-adjusted performance. And the reason for that is, and again, I won't go through each of the numbers on the slide here, the reasons for that is the correlation to public equities is significantly low, meaning as private infrastructure acts as a diversifier in your overall portfolio and enhances the risk-adjusted return. And it also does that with significantly lower volatility compared to what you may experience in a public markets portfolio. The other very important feature of infrastructure as an asset class is it's seen as an inflation hedge. And again, for investors who've had exposure to it or not in higher inflationary environment have experienced it or noticed it pretty significantly. In a lot of these infrastructure assets, you have some sort of inflation linkages in the contracts, meaning in a high inflation environment, it doesn't impact the performance as much as it may do, for example, in a private equity transaction or in a publicly held company. Again, it is seen as an inflation protection as well. And last but not the least, it has a component of income generation. We'll look at what are some of the different types of infrastructure assets you can invest in, but there is a component which is somewhat similar to private credit in the sense that it does have steady state income feature to it as well. So what does the Global Private Infrastructure Fund look like? So this is one of the newer entrants to our Evergreen platform as we launched the fund to external investors in September of last year. Prior to that, we used 30 million of our own balance sheet to build a seed portfolio. The early investors were not coming into a shell vehicle without any investments. Fast forward to today, from our launch in September last year, we are over $400 million in size. So it has been a pretty nice, steady growth of the fund since inception. Similar to GPA, it's a combination of direct investments and secondaries and fairly diversified across any different metrics we may look at. The target return for this fund is similar to GPA, which is 10 to 12% net of fees on an annualized basis. It also has a distribution component similar to Scope, but a much smaller distribution. So there's a 2 to 5% annualized distribution target for this fund. Otherwise, coming into a fully deployed portfolio right from the onset, right from day one. As I mentioned briefly, we used the piping and plumbing that we had for GPA already We had a pre-existing infrastructure platform that was historically doing closed-end funds, and we just brought the two together. So we used the same philosophy that we used in GPA for GPI as well, where we decided on a combination of direct equity as well as secondary transactions to be brought together in one portfolio. So you get the benefit or you get the return profile that you want to achieve, but you also get the diversification and the liquidity profile that you want to achieve. So again, secondaries being more liquid, more diversified, equities, longer duration, and more concentrated exposures. So bringing the two together gives investors a nice mix of returns. Similar to GPA, our focus on this fund is more on mid-market because that is where we see the sweet spot from an opportunity set standpoint. Now, if you think about the area within infrastructure that we focus on in this fund, if you think about the infrastructure landscape overall, one end of the spectrum is your core assets. Now, these are very large, steady assets, been in existence for a long period of time, fully developed, in a lot of the cases, contracted revenues for the next X number of years, pretty steady, yielding assets, quite similar to private credit. That is one end of the spectrum. So there's the safe assets, there's yield, there's not much upside or future value add that can be done. The other end of the spectrum is the more opportunistic assets. Now, these might be assets that still need to be built up. There's a lot of upside, naturally comes with a lot of risk as well, but it is early stages of the investment. Somewhere in the middle is what we call core plus and value add. And that is the key focus of the fund for us here, where those are the assets where there is some component of contractual return or yield. Those are sort of more of the core plus assets. But at the same time, there is room for future growth. There is room for future value creation and more equity-like returns and more upside. And we decided on a combination of these core plus and value add features so that there's some safety and income component, but also some more upside in the overall portfolio as well. So that's really the sweet spot for us and the focus of this fund. A few investment themes to highlight, which makes infrastructure as an asset class particularly attractive, given some of the industry tailwinds that we are seeing. Four very different things, but all boiling down to infrastructure as an asset class. And again, none of these would be unfamiliar to any of us looking at this right now. Firstly, energy transition. You think about renewable energy generation, you think about many other things, the focus that is there globally on energy transition, it boils down to building the infrastructure assets to generate or make that transition. Next is supply chain and logistics. Rails, seaports, whatever you may think of, all boils down to large, huge infrastructure projects. And again, in order to get access to it, unless it's publicly listed, you're getting it through private infrastructure. Digitalization, things like AI, the need for data centers, once again, boils down to infrastructure. And then last but not the least, environment. Things like waste management, resource efficiency, once again, boils down to the need for large infrastructure projects. There's a few stats on this slide. I won't go through them in detail, but just gives you an idea of the quantum of opportunities in just one part of each of these spirals. So from our perspective for this fund, the areas that we'd be focusing on is basically these four pillars and investing across the board here. So what does the fund look like today? Again, over 400 million in size, fairly diversified, over sort of 30, 35 investments, over 100 positions. If you look at the number of underlying assets we have exposure to, a good balance between co-investments as well as secondaries. Geographically, quite similar to GPA, 73% North America, 20 Western Europe, and then rest of the world. Strategy-wise, a good balance between our core plus and value add, which is what our target is, and then fairly diversified by sector, industry, by vintage year, and again, similar to our other funds, by GPs as well. You also see the performance numbers for the fund here since inception. We've had an annualized performance of 28%, which is quite high, and I'll get to it in a minute. Year to date, we've had a performance of just over 11%. Now, Some of the early performance numbers for these funds can be a little bit skewed. So what you see in year one, because the portfolio starts with one investment, two investments, three investments, it can be a lot more concentrated. So as a percentage return, it can be a lot higher. But steady state, that 10 to 12% net of fees and expenses is what we are targeting for this fund. And so far, we've been well ahead of that, not just since inception, but even if you look at year-to-date performance in 2025. I'll wrap up here with a quick snapshot of the return profile. And these are not specific to our funds, but overall, if you look at the asset classes, so private equity, credit, and infrastructure. And we've looked at the lowest 5-year annualized performance, meaning over a 5-year period, what's the worst you could have achieved? There's a couple of things to note there. One, consistently in all three of them, you as investors would have done better than what you would have achieved in your public markets portfolio. And secondly, even the worst case return or the lowest 5-year annualized return has still been a positive return. The reason I wanted to sort of highlight this and wrap up with this was generally, and especially investors who've not done private markets before, the perception is it's a riskier asset class. But if you look at the volatility profile of it, if you look at the return profile of it, it proves otherwise. So something to be aware of if you consider the asset class or any of the areas within it. So to wrap up, overall, private markets within a portfolio does provide outperformance. It does it with a lower volatility and lower correlation to your public markets portfolio. And with these evergreen funds, it's giving you some flexibility as well as a fair bit of diversification, both at the asset level as well as the GPs that we would be investing with. And with that, happy to wrap up and take any questions.
Thanks a lot, Hamza. This was, as usual, very informative, very interesting. There are quite a few questions, but before I jump into, and I spent some time trying to club them so that we kind of address as many as possible of them in groups. But before I go there, I want to ask you one question for me, which is around portfolio management from a high net worth individual, somebody that has anywhere between $2 and $10 million in investable assets, and probably historically has had close to zero private markets exposure, maybe invested in a couple of friends' companies, angel investing, or maybe bought this, one private equity fund because a private bank pitched it, and now maybe thinking about it in a bit more, strategic way. And I mentioned earlier, 23% average allocation of institutional investors to alternatives, and private markets being a large part of that. If I look at my personal portfolio, I have now 12.5% of my wealth in private credit, around 6-7% in private equity between semi-liquid and direct, and 4% in infrastructure. So it's around 22%. Within the three categories. How should someone like me, just maybe use me as an example, think about this, both in terms of how important it is in a portfolio, so it should be 5% or 90%. And secondly, also how you think about how much credit versus infrastructure versus private equity.
Yeah, so I think first and foremost thing is there's no one size fits all, right? I think investors, when they're looking at their overall portfolio, their goal, what they're looking for from a return perspective, from a liquidity perspective, will be different. I think typically what we see is you can see anywhere between, say, 10% allocated to private markets to 50% allocated to private markets, right? So it really is something that is that varies. I think the key thing to note is what each of them is offering is a little bit different. If you're looking for a longer term return, not so concerned about an income component of it, something like private equity gives you that. If you want purely income, private credit gives you that. If you want something which is somewhere in the middle, a little bit of income, some upside, infrastructure gives you that with an inflation protection. What we have seen, though, is more often than not, investors will first and foremost decide how much they want to allocate to alternatives and within that private market. And then within that, there is merit in having a combination of all three of the strategies. So rather than just picking one, have a combination of all three, because all three of them are being a little bit different in your portfolio.
Thank you. So there is a question on fee structure. Maybe I'll address it very quickly. So in practice is, what are the fee structures? So there is a fee charged by Hamilton Lane and a fee charged by StashAway. On the Hamilton Lane side, the private credit fund, what Hamza called Scope, charges 1.25% management fee and no carry. Now, I want to highlight the no carry because it's quite unique in the industry. So I promise you're not going to find anything better priced than this in the market. So that's 1.25 no carry for credit. For infrastructure, it's 1% no carry. Now, this is again actually by far the best deal you're going to find in the market. Both on the management fee side, 1%, and especially also because there's no carry. And on the private equity side, it's 1.5% management fee and 12.5% carry. Again, probably best fees you're going to find in the market. StashAway charges 0.5. So these are the Hamilton Lane fees. StashAway charges 0.5% on the NAV. Again, I don't think you're going to find anyone charging anywhere remotely close to what we charge. So overall, as you know, our value proposition is always to make it simple and cost effective to invest intelligently. Hamza spoke a lot about the intelligence behind what is it? I mentioned at the beginning the simplicity, the semi-liquid minimum kind of $20,000 minimums, very easy on the app. The second bucket, the cost effectiveness, is a core part of the value proposition. This is probably the most cost effective way to get exposure to private market that you will find anywhere you go. Yeah. So that's on fees. Now, moving on Forex exposure, Hamza, this is, I guess, an easy one, but let's just get it out of it. There's somebody asking, okay, are those returns in US dollars, Singapore dollars? Obviously, the returns you showed are all in US dollars. And somebody saying, okay, does that mean that in Singapore dollars, I would be losing money this year given Singapore dollars appreciation? And whether there is a Singapore dollar share class, short answer, not yet. Anything you want to say about this?
So I think we have a number of share classes that are partially hedged for these. So for GPA and GPI, we typically target 70% hedge, for Scope 90% hedge. Today we have hedge share classes in Aussie dollar, Canadian dollar, euro, sterling, Swiss franc, which has really been driven by investor demand. We do have a Singapore dollar share class in for GPA, but that is unhedged because that is what the initial investor interest was. You have a Singapore dollar share class, but that is unhedged, that will have exposure to FX.
Thank you. So again, short answer is you are taking US dollar exposure through these investments. And in general, when you invest in private markets, if you invest globally, you will get, this is not purely US dollars. There is, as Hamza showed you, some European exposure, some APAC exposure, but obviously the US is just the largest and deepest market for private markets. And so you will get some US dollar exposure. The way you need to think about it as part of your portfolio, this is part of your portfolio that gets you some US dollar exposure, which you want in your portfolio overall. And yes, there will be periods like the last 3-4 months where the US dollar will depreciate. There will be periods that it goes in the opposite direction. Given this is a long-term investment, you need to think about it with a long-term view. Don't look at US dollar appreciation or depreciation on a monthly basis, because then it's going to be very difficult to think about your currency allocation over time. Now, there are a couple of questions asking about what does semi-liquid mean? Maybe I know you spoke about it earlier. Can you maybe explain again why is semi-liquid, what is not illiquid or is not liquid?
Yeah, it is semi-liquid because it's not a fully liquid investment where there is the ability that the fund gets gated and you basically have to wait to get your capital back. So in a traditional private equity fund, you have no ability to get your capital back. You basically need to wait to get the distributions from your manager. In this fund, you have the ability to redeem on a monthly basis, but there is a cap on redemptions at the fund level. So at the overall fund level, the maximum redemption that the fund would allow is 5%. If the redemptions come in, say, 7%, the redemption will be capped at 5%. And that is why it's semi-liquid and not fully liquid. And again, we can't make these funds fully liquid because this is not a public market portfolio. It still is a private markets portfolio where your underlying investments are longer term.
Thank you. So let me go deeper. Actually, let's talk about semi-liquid for a second again. There was a question on when you were speaking of GPA, so you hadn't spoken about the other one yet, and somebody was asking about the three asset classes that you get. I mean, not really three assets, the three exposures. Private equity, so direct equity, direct credit, sorry, and secondaries. You had not yet shown the slide showing kind of 90% equity, 10% credit. Do you want to maybe speak a little bit more about why you have some credit portion in GPA? And again, just for everyone, GPA is really an equity exposure. So it's private equity and a little sliver of venture capital, and credit is there for the reason I will explain in a second. Credit exposure is with private credit. So on the StashAway platform, you'll find private equity, private credit, infrastructure as three kind of defined different exposures. Hamza, maybe clarifying the credit portion within private equity.
Sure. So we wanted credit in GPA day one when we launched the fund, because remember, your equity and secondary positions are not going to give you liquidity immediately. So we needed to be able to make those have that liquidity in the fund right from the beginning, right from day one. So that's why when we launched the fund, we put a sleeve of credit in it. Now that the fund is over 6 years old, we are naturally getting liquidity from the equity and secondary positions. We've de-emphasized credit. So if you looked at the credit bucket last year, it was probably at 15%. Today it's at 10%, and we would expect it to continue to decrease in size.
Thank you. So let me read one question that goes again a bit deeper on the GPA. How does the GPA fund offer more liquidity and dynamic allocation than traditional funds? Aren't there investments locked in for longer periods like other funds? How is the fund able to offer dynamic allocation from that point? I guess, again, talking about how you generate liquidity.
Sure. So that again boils down to a few things. Number one is how we've constructed the portfolio. Typically, in a traditional fund, say if it's a private equity only fund, you only have direct equity investment. You don't have secondaries which have a shorter duration and are generating that liquidity. Secondly, as we had credit, you were getting some liquidity naturally from credit as well. Thirdly, at any given point in time, you may have some structural cash in the fund. So anywhere between 5 to 10% of the fund would be cash that is earmarked or penciled for deals waiting to be funded, and you can utilize that cash to bridge any liquidity gaps. Finally, we also have a credit facility that sits as an unutilized pool of capital to bridge any liquidity gap. These are all theoretical measures of how liquidity is managed. On a more practical side, we have a dedicated portfolio management team that is purely focused on risk and liquidity management of these funds. So on a weekly basis, the cash for the fund is projected on a day-by-day basis to say how much cash we have, what are the inflows, what are the outflows, what are the redemptions, what are any distributions that we're getting, to make sure that we can stay on top of any liquidity needs for the fund. So I would say, broadly speaking, how the portfolio is constructed means natural liquidity generated through distributions with some other mechanics such as cash, such as the credit facility, and then the more active management of the liquidity on a day-by-day basis.
Thank you. So I'm going to ask you a few questions fund by fund. So one, again, to close up on GPA, so on private equity, somebody was asking, what's the median EBITDA and leverage of the companies in the fund?
Yeah, so I would say the median EBITDA is probably around 150 to 200 million. If you look at the leverage, again, varies by sector, but I would say anywhere between 5 to 7x EBITDA.
Yeah, and maybe as a broad commentary here, this is a kind of a targeting because the so-called mid-market, which is very deep, very large market, particularly in the US, and tends to kind of deliver higher returns than the large cap market in the private equity industry. Now, let me move to infrastructure. There's quite a few questions there. Maybe let me start. There are a few. Let me start from this one. Mark is asking, what are the types of infrastructure assets the GPI invest in? Are they all income producing types, or are there growth type of assets companies that do not produce income yet?
So it's both. So if you think about how we're saying that some assets are core plus, some are value add, some of those core plus assets will be, say, take one example, it's a deal called Italo, which is sort of, Michele, you might be familiar with, which is the railway system in Italy. That is an income generating asset, right? There is an income component to it. You may look at some of the others, which are data centers that are being developed where there will be revenue in the future. Those are more value add assets. We have a combination of both of them in the fund.
Okay, and talking about distribution, there are two questions. Again, for infrastructure, one is why is distribution only 2.5%? I think you said 2.25, not 2.5. But anyway, why is 2.5%? And then there is a question on share class, accumulation share class. I can actually tackle that one. Maybe I'll let you talk about the distribution amount.
Yeah, so the reason distribution target for GPI is lower is because we're not just targeting core assets. So if you were doing pure core assets, that would be lower return profile, but all being income generating. Because we are doing some core plus some value add, not all your assets, to my answer to your previous question, and not all assets are generating income. So that's why we've kept the distribution target much lower, because the distribution from within the fund would be lower than a credit portfolio or a core only portfolio.
Perfect. And connected to this, somebody was asking, does infrastructure have an accumulation share class? Let me answer that. So we actually, as well as we do for private credit, we invest in a distribution asset class, and then we actually provide the option to kind of make it accumulating by reinvesting automatically your dividends. That's what we do in private credit as well. So, for instance, on private credit, if you invest through StashAway, the app will ask you, do you want to reinvest your dividends or do you want to withdraw them? And you can change that selection at any point in time on the app very simply. We're going to do the same for infrastructure. As of now, because dividends are not as frequent as with private credit, we're simply, you consider it an accumulation asset class anyway. So in practice, it is the only thing we do right now. Now, one last question on infrastructure. We might have spoken about it before, but perhaps worth just looking at it again. The question is public infrastructure similar to scope to private credit, but investing only in infrastructure? Looking at the four themes that may require large capex and strong execution expertise, wouldn't focus in a middle market means more delinquency and default risk? What's the past experience?
Yeah, so I think it boils down to your investment selection, right? And if you look at ourselves as co-investors, what we end up seeing, we typically do sub 2% of the deal flow that we see. And that is where the opportunity truly comes up, because in the mid-market space, there's a lot more in terms of opportunities that you can pick from, but you need to be selective on the investments you go into. So that's why, and again, not to say that there won't be any defaults in mid-market space, but it boils down to how selective you are in those assets and how picky you are in terms of the investments that you make. From our perspective, given the fact that the investments that we are looking at, there's already a general partner that is committing capital to it. And from within that, we're picking and choosing only investments where we have very high conviction. It gives us the ability to only pick and choose the best assets.
Thank you. Just trying to see that we have answered all of the one on infrastructure. I believe so. Okay. On credit, first, there is a question. I'm not sure I fully understand it, but maybe I'll ask you if you will understand it. Are there differences between investing in direct credit versus private credit investments? Maybe, just explain how the fund works.
Yeah, unless you mean by private credit investments into private credit funds, yes, there is a difference, because here we are going directly into the loan of the company. So we are not committing capital to other funds. We're going directly into the loan. So there is no double layer of fees. As I was mentioning, we would get exactly the same return profile as the private credit manager. Again, not sure if that question meant something different, but if it's asking whether it's directly into the asset versus fund, yes, there is a difference.
Yeah, exactly. So in practice, the Hamilton Lane Fund, together with the kind of that you invest with StashAway, invest in direct credit private opportunities. You're not investing in you're investing in a fund that invests in a lot of direct credit opportunity. That's, I guess, the logic for StashAway clients. On private credit again, we talked a little bit about risk. We talked a little bit about the fact that the fund invests in 90% in first lien securities, and the safest part of the cap table of a company. Actually, in reality right now is 99%, but in theory 90%, minimum 9%. what are the historical default rates that you guys have experienced on this part of the cap table, and how should someone think about risk? You mentioned earlier this is a fund that has been operating for 6 years and never had a negative month, so obviously that speaks to the to the stability of the returns. But how do you think about it, the underlying risk?
Yeah, so I think when you think about, and I can talk about from our experience, for Hamilton Lane as a firm, for senior credit, our default rate, knock on wood, is 0% so far. And I think that boils down to, again, the selectivity that we have on the deal. This is not to say that there will never be a default. We have 100+ positions in the fund, so there is every possibility at some point you may see something. We've not seen that as yet. The way you monitor them or the way you tackle with these funds is given the diversification that you have. If you look at the fund today with the number of underlying positions it has, any one position is typically sub 2 to 3% of the overall fund size. That gives you a fairly diversified exposure, where even if at some point there is some level of default at any company, it doesn't have any major drawback or impact on the fund itself. But overall, our track record on senior credit is pretty solid, and we've not had that default.
Okay, thank you very much. Super clear. Let me see if I have anything else. So yeah, there is actually a follow-up on fees, asking whether the fees are charged on NAV or commitment. In the semi-liquid, this is charged on NAV. Is that right?
Exactly. There's no concept of committed here, remember, because in the closed end, you commit and then it's called. Whatever is committed is all called. So it's all.
Yeah, exactly. So, and this is a little bit the advantage, as we discussed earlier, of investing in a semi-liquid versus in a liquid. There are pros and cons, and in general, it makes it much easier to have proper kind of an easy allocation to private markets. And one of the reasons is that because you don't have this concept of reserving capital for future commitments, but rather the capital gets allocated immediately. And so the IRR or the return you see here is actually really on cash. While when you think about a private equity, a traditional private equity program, the IRR is only when capital gets called, but then in reality, you need to park your cash somewhere for a period of time. And so, the actual returns might actually differ from what the IRR says. So, but yeah. Look, I actually think I went through all the questions, Hamza, and I know we are actually 15 minutes behind schedule. So thank you so much for allocating an extra 15 minutes of your time. And thanks to the people that have remained, actually, a great majority of people are still on the call. Again, thank you so much to everybody that participated. Thank you for being here. Thank you for the questions. If anything is unclear or you have any more question that comes in tomorrow, reach out to my colleagues. Maybe as a reminder, if you want to invest in August, the deadline for this August submission is on the 15th of August. And therefore you might want to get in touch with the wealth advisor quite quickly because it's a week away. And it might take time to just move the money. So the money needs to be with us by the middle of the month. So just again, if you're interested in going deeper, please do so tomorrow so that you can make a decision. Otherwise, you'll need to wait for September. Hamza, again, thank you so much for, as usual, incredible depth on the presentation. It was really informative, I hope, for everyone, definitely for me. And, I wish you a good evening at this point.
Thank you very much.
Thanks, everyone. Thank you. Bye-bye.